Okay, we're here on the House podcast, coming at you virtually here because of all the obvious precautions that we need to take due to coronavirus and the possibilities of COVID-19. So, welcome to our listeners, and welcome back on the podcast today, Evan Gottschalk with First Federal Savings Bank here in Rochester, Indiana.
Hey, thanks, Alex. I'm happy to be back on the podcast. It's always good to get an invitation back.
Yeah. Well, it's not a full invitation. You're not invited back in the shop yet, but we can do virtual for you.
The worst we can do right now is a computer virus. So that's good, I think.
That's right. So, I just want to do kind of a brief chat today because obviously we've been watching mortgage rates kind of roller coaster here in the past month, and we've got a lot of people asking us what's going on. But before we get to that topic real quick, how are you guys holding up over there at First Fed?
It's been an interesting 2 weeks. I can say that for sure. We've had a pandemic plan on the shelf for the last 10 years. I never thought we'd have to use it. But we are using that right now. And that helps us with the protocol for social distancing and separating our workforce and those kind of things. So over the last 2 weeks, we've been incrementally putting those parts of our plan into place and having daily, if not more often, pandemic team calls. And the whole idea is to just protect and care for our customers in the best way that we can to keep them safe, and then also our First Federal family members. So our team has been doing an awesome job of adapting to, we call it day by day or fact by fact changes that are occurring and the different information that's flowing. It's a little bit exhausting, but the First Federal family is doing an amazing job of changing conditions at work or being at home in some cases.
Sure. Yeah. And I mean, we really appreciate what you guys and your employees are doing because, obviously you're an essential business, you're a bank, and we need to be able to keep our banking going so that we can, pay our employees, pay our vendors, and take in payments from our customers and such. And just being able to keep the drive-through open and keep basic banking function open has been really helpful to us. So glad you guys had a plan in place and seem like you're attacking it pretty well from our perspective.
Well, thanks, Alex. Yeah, we've been saying in general, hey, this is our time to shine and really serve people that are anxious and worried about some of the information coming out and what could happen. And so we're trying to remain very stable and provide that standard service. So great. Okay. Glad to hear that.
Yeah, we'll keep up the good work from that perspective. But to get to the main point here today, so I think it was 10 or 15 days ago, maybe it's a little bit longer, we saw rates just drop, mortgage rates. And I think at one point, even the 15-year was down to maybe like a 0.2875, really low. The 30-year might have been down even close to 3. Am I wrong there?
No, that's correct.
Yeah, and then the coronavirus really started to impact people's ability to go to work, and it started to impact the economy. And we saw the Dow, the Nasdaq, the S&P 500 all just nosedive. Some major corporations out there that hopefully are going to get some kind of stimulus, they were all nosediving. And as that nosedive occurred, the Fed came out and said, hey, guns blazing, we're going to do what we can. We're going to lower our interest rates. And so we had some customers that maybe even put their new purchase on hold for a minute, thinking, hey, if the Fed rates are dropping, our rates are going to drop too. And then we saw the opposite of that happen. They were actually raised in the days after the Fed rates were officially dropped. So from your perspective, and you're obviously within the industry insight, can you just give us a background on what was going on there through that roller coaster and what's really driving the change in rates?
Yeah, that's a great question. And we had a lot of our own customers asking those same questions, Alex, about, hey, I heard that the Federal Reserve dropped interest rates to almost nothing. Should I refinance right now? And sometimes those events correlate to lower mortgage rates, and sometimes, as we saw, they don't necessarily. And really, that's just because the mortgage rates are a separate market than what the Federal Reserve was doing with the rates that they can change. And the mortgage market is really built off of the bond expectations, the bond market. And really the closest correlation that we'll have for mortgage rates, market mortgage rates out there, is that 10-year US Treasury bill. That's really what, if you want to kind of understand what maybe mortgage rates might be doing from one day to the next, then we always recommend watching that 10-year US Treasury. And the situation that you're referencing that happened that was so strange is when the Fed lowered those Federal Reserve rates that they loan to have banks borrow from, those mortgage rates didn't change just because the 10-year US Treasury actually went up a little bit. And I think
Okay.
that's because the Fed came out so strong, like you said. They were
Mhm.
very aggressive and they came out with a large package. And the next day, they came out with even more information that they were going to be doing. And we just saw the Federal Reserve Chairman this morning on the Today Show saying, hey, we can print unlimited amounts of money and we're doing this and we're doing that. So they're not going to drop the ball on this. And that's actually given some confidence um, into the bond market. Really, a market, when you define that, that's just a bunch of people kind of figuring out what their expectations are
Yeah.
through
Speculating
financial
almost. Yeah.
transactions. That's exactly right.
Yeah.
So really we're talking about something that the market thinks, okay, a bond gives you a certain interest rate if you're investing in that. So how does that compare with inflation? And that's usually what prices bonds up and down is, okay, I think inflation's actually going to be better than what these bond prices are today, so I'll do this, or I think inflation's going to be worse. So I think what you saw there is a momentary confidence that maybe the economy was going to be okay because of the Fed's aggressive action, which actually caused mortgage rates to go up a little bit.
Okay. So, it sounds like because there's a long-term confidence that the Fed was doing the right things and that the government maybe has been doing the right things is the reason we've seen it inch back up. So, at one, I appreciate all that info. It's so helpful. I think you even told me some of that during our last conversation, but it's just hard for myself and I assume other people too to not just tie that Fed rate into, oh, that's what my mortgage rate is going to act like. I always go back there, but hopefully one of these days you'll ingrain this in me and I'll start looking at that 10-year treasury number.
I think it takes 7 times to hear something till you remember it, Alex. So good
Yeah.
luck on that.
6 more podcasts, 5 more podcasts will be good. I'll stop wasting your time then. So since there's maybe a little bit of long-term hope to this, and I've heard this idea from some, a lot of different economic pundits right now is we're, the market's been in a steep decline. We understand people are scared. Obviously, we're all locking our doors and trying to maintain social distancing. We're going to see
Right.
a steep decline, but a lot of people believe we're going to see a steep incline in the market as well once we believe that the COVID-19 pandemic is under wraps, maybe isn't the right word, but under control a little bit better than it has been. A lot of people believe that there's going to be a big market uptick, and maybe the 10-year Treasury bill is kind of pointing to that. Is that what you're hearing too? Is that what you guys are seeing?
Yeah, the economists that we kind of get some of our information from on a day-to-day basis, we've read from a few different ones similar to what you're talking about, Alex. Q3, Q4, that's quarter three, quarter four, could be extremely good quarters in terms of the history of the U.S. economy. And really, I
Mhm.
think that speaks to there weren't really many underlying concerns with the economy before this virus outbreak. And
Yeah,
so, if we can control the infection rate, if we can contain it and kind of get businesses back working and operating again, employment, those are going to be the key factors. I think that if we can get a handle on that in terms of, maybe it's hospital capacity, if we can get everything to work out so that there aren't more infections than we can handle, then we should be back in kind of the same spot we were in, as long as some of the stimulus works out as well,
sure.
which we're interested in tracking when that gets passed and what kind of impact that may have. But that's what we're hearing too. So it's good for me to know too that you're hearing the same.
Yeah,
Is could be an excellent second half of the year if we can weather this first part, and I think that speaks to just a little bit of social responsibility that maybe we have and we're understanding a little bit more. Is we're really talking around here at the bank about, hey, let's really listen to these guidelines when we're not at work,
yeah,
so that we're not bringing something in and inadvertently helping shut down another part of the economy. Let's really do what we can over the next 2, 3, 4 weeks, and then see how it goes, and kind of check in and see if we were able to kind of help contain the virus spread in our markets and communities. So that's really what we're focused on, and I think that really should help kind of get things back on track. And I read something earlier today about the Wuhan area of China, and we know that's where kind of some of this really first hit.
right.
Is they're starting to open things back up and remove some social distancing now, which is a great sign, and it could allow for some more infections to increase again. But they're moving forward with getting the economy growing and operating again there. And I think that's something that, we're going to be looking forward to here. And maybe it's May, maybe it's June, we don't know. But things getting back online and being able consumers to be able to go move freely, spend money, and go do some entertaining type things.
Sure. Yeah, I'm sure people are going to want to get out and get back to it. And the bottom line is we still have a housing shortage in the country. Uh,
Right.
Great mortgage rates continue to hold, even though we saw a slight uptick from 10 days ago. They're still incredible rates. You can buy a lot of house for the money that you're borrowing right now. So we're
That's
with you.
true.
We got fingers crossed for Q3, Q4, and we hope our customers and your customers will take advantage of that.
And I would say too, 10 days ago rates went up a little bit. That was confusing. They've since come down again some. So you never know. And that's what we're dealing with here at the bank is these rates can kind of whipsaw up and down by 0.5% from one day to the next, which is incredibly unusual. And we're kind of excited for those to stabilize a little bit.
Yeah, I
In the
bet.
meantime, yeah, it's crazy. And then in confluence with the virus concerns and trying to keep the operation going, it's very, very busy here, which is a great business opportunity for us. And we're trying to make sure we're meeting all the needs. But thinking of the interest rates going up and down, you're right. You can buy a lot of house right now. You can get a little bit bigger construction plan than maybe you were planning on just
Sure.
because those interest rates. You're not having to service as much interest debt, and it can allow you to your ratios to give you a little bit more capacity for maybe that next size up home or a little bit bigger build, and that's really exciting for what we're finding for our customers.
Yeah. Good, good. Well, I promise you I wouldn't take up too much of your time today. I really appreciate the time that you've given us and the insight you've given us today. Thanks for reminding me and some of my customers how things really work out there in the banking world. That's really helpful. And just take a second, if you would, and tell us, how we can get a hold of you guys at First Federal. And from my perspective, you guys are a great bank to do business with. But feel free to tell the folks why they should do business with you guys here for a minute.
Thanks, Alex. Yeah, we are the mortgage leader in North Central Indiana. We also have capability of servicing your mortgage anywhere you might be in Indiana, Michigan, and the surrounding states. www.firstfederalbanking.com. You can apply now for a mortgage, and we can go ahead and get that going for you and take care of the whole thing, start to finish, electronically and virtually for you to facilitate that. We pride ourselves in servicing your mortgage loan till you pay it off, and that's really where the rubber meets the road for a lot of people. Is we will be here with you the whole way, and we take a lot of pride in that. So our philosophy is we don't want to be the biggest bank, just the best. And we have a real niche in flexible residential lending. We can do portfolio loans as well as any of the secondary market type products. So we also specialize in construction lending where you only have one closing. And we take a lot of pride in those and take care of that start to finish as well. So please look us up if you're looking to build, buy, or refinance your home.
Awesome, Evan. I hope the Gottschalk family is staying safe and sane at home, and hopefully the First Federal family continues to stay safe. And good luck to you guys out there. Thanks for your time today, man.
Same with Rochester Homes. We care about you guys. Stay safe. And I don't know about the sane part. We're working on that right now.
Yeah, we are too, man. All right. Thanks, Evan.
You're welcome. Thank you.
Yep. Bye.